Are you kidding me? You have worked hard your entire life. You gave your blood, your sweat, your tears to a company for 20, 30, or 40 years, all with the promise that a monthly pension check would be waiting for you to give you peace of mind in your golden years. And now that you are finally at the finish line, or you are looking at it just a few years away, you are hitting the brakes because a terrifying question has popped into your head: is the government going to take a giant bite out of my hard-earned pension check? I want you to take a deep breath, stand up straight, and look at me. Because today, we are going to talk about the reality of your retirement money, and we are going to get down to the absolute truth, because what you don't know will hurt you. The short answer, the painful truth that you need to face right now, is yes. For the vast majority of you, your pension income is absolutely 100% taxable. The IRS looks at that monthly pension check you received or are about to receive, and they do not see it as a special reward for your lifetime of loyalty. They see it exactly the same way they saw the paychecks you earned when you were waking up at 5 a.m. every single morning. They see it as ordinary income. That means it is taxed at your standard federal income tax bracket, which could be 10%, 12%, 22%, or even higher depending on how much total money you have coming in. Now, I know what you are thinking. You are feeling angry, you are feeling fearful, and you are thinking, Susie, how is that fair? That was my money. But I need you to understand how it got into that account. If your employer funded that pension entirely, meaning you didn't put a single dollar of your own paycheck into it, or if you made contributions using pre-tax dollars where you got a tax break at the time, every single cent that flows out of that pension to you is fully taxable. The only exception, the only silver lining here, is if you personally contributed after-tax dollars to that pension plan while you were working. If you already paid taxes on a portion of the money that went in, the IRS cannot tax you on that exact portion when it comes out. They use what they call a simplified method to figure out exactly how much of your monthly check is a tax-free return of your own money, and how much is taxable ordinary income. But for most of you, you didn't put after-tax money in, so your pension is going to be fully taxable. But here is where the real danger lies, and this is the trap that trips up almost everyone who is about to retire. It is not just about the federal tax bracket. It is about the dangerous, hidden domino effect that your pension has on the rest of your retirement portfolio. Think about your Social Security benefits. You might think your Social Security is safe from the taxman. But the IRS looks at your combined income, which is your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security benefits. Because your pension counts toward your adjusted gross income, that pension check can push you right over the federal income thresholds. If you are a single filer and your combined income goes over just $25,000, or if you are married filing jointly and it goes over $32,000, suddenly up to 50% or even 85% of your Social Security benefits become taxable too. Your pension, the very thing meant to secure your life, can act like a magnet pulling taxes right out of your Social Security checks. And we cannot forget about where you live. Do not just look at the federal government. You have to look at your specific state. Right now, more than a dozen states do not tax pension income at all, states like Alabama, Illinois, and places with no state income tax like Florida or Alaska. But if you live in a state that fully taxes pensions, you are getting hit twice. You have to know your local laws because state taxes can drastically reduce your monthly spending power. So, what is the actionable takeaway here? What are you supposed to do so you don't end up broke and filled with regret? First, you must act before the checks start rolling in. When you fill out your retirement paperwork, you need to look at Form W-4P. This is the withholding certificate for periodic pension payments. If you do not tell your pension administrator how much tax to withhold, or if you just ignore it, the default withholding might not be enough, or it might be too much, leaving you with a horrible surprise in April. You want them to withhold taxes directly from the check so you only see, and only budget for, the net amount that belongs to you. Second, if you have not retired yet, or if you have the option to choose between a monthly annuity payment or a lump sum payout, you need to think very carefully. A lump sum payout gives you all the money at once, but if you roll it over directly into a traditional IRA, you can defer those taxes and control exactly how much you withdraw each year. If you don't roll it over and you just take the cash, the default federal withholding is a massive 20%, and the rest could push you into the highest tax bracket of your entire life in a single year. Third, you need to look at the current tax laws available to you right now. If you are age 65 or older, make sure you are maximizing your standard deductions, including the temporary senior bonus deduction if your income falls below the phase-out limits. Every single deduction you claim reduces your adjusted gross income, protecting your Social Security from being taxed. I want you to be powerful. I want you to be secure. Do not let the fear of taxes paralyze you. Taxes are a cost of doing business, and living a beautiful, retired life is your business right now. Face the numbers, adjust your withholding, plan your state residency, and take control of your financial destiny today.